Good morning, everyone, and welcome to the Actuaries Club of the Southwest Spring 2026 meeting. I'm Phyllis Tumel. I serve as the president of the club. Thank you so much for being here. We hope you enjoyed this week's program. Before we get started, a couple of housekeeping items. First, if something comes to mind during the presentation, please go ahead and submit your questions through the Q&A feature. We'll get to as many as we can at the end of each session. Second, this meeting is part of a 5-day webinar series, and we hope you'll be able to join us throughout the week. With that, let's get started. I'm very pleased to introduce our first speaker, Bingjie Lee. Ms. Bingjie Lee is a managing director at Reinsurance Solutions, where she focuses on corporate development, reinsurance, and strategic initiatives. She joined RS in 2020. Previously, Ms. Lee was a senior director in corporate development at Athena, leading pricing and evaluation on mergers and acquisitions, reinsurance transactions, and pension risk transfer deals. Earlier in her career, she held actuarial roles at AIG, Ernst & Young, and Towers Watson. Ms. Lee holds a BA in Mathematics and Economics from New York University and an MBA with honors from University of Chicago, Booth School of Business. She is a CFA charter holder and a fellow of the Society of Actuaries. Bingjie, thank you for being here, and I'll turn it over to you.
Thank you. Today I'm going to talk about asset-intensive flow reinsurance. I will be sharing my screen, and if you have any questions, feel free to ask in the chat box that I'll be monitoring throughout and answering that as we go. So let's start talking about what is a reinsurance and why do companies need reinsurance. So insurance companies sell policies to policyholders, and sometimes they will need to transfer certain risk to be comfortable about the product they're writing. And sometimes they will need pricing support to make the product more competitive. And sometimes they will need some capital support to relieve the capital strain. And asset-intensive reinsurance comes to play when the capital need for certain product is high. So for example, if you issue some fixed annuity products such as MYGA or FIA, MYGA meaning multi-year guarantee annuities, where you guarantee certain credit rate to your policyholder for certain tenors, like 5 years or 7 years or 3 years. FIA meaning fixed index annuities, where policyholder also buy a policy from you and get exposure to equity market while still have the downside. Those type of product will need a lot of capital under RBC work framework. So insurance companies sometimes will need capital relief when they issue the new policy, or when they have a block of insurance policy that they want to relieve capital strain. So that was the number one goal why reinsurance is needed. The second is if the companies have certain threshold for each type of business, they might want to offload certain risk to reinsurance companies. For example, if you only want 20% of your book to be in fixed annuities and you roll 30 to 40%, then one way to do that is to offload that to your reinsurer and keep that to be your 20% cap that your company has. And the third reason to use the reinsurance under asset intensive is just to diversify your earnings. Because typically when you do reinsurance with a reinsurer, you get a commission called ceding commission, and whether that's upfront or trail, that will increase the earnings profile for your own remaining book of the business. And this page also have an illustrative reinsurance structure that we can go into more details in the next page, where to begin with, insurer issue a policy to policyholder, and policyholder will pass the premiums, and reinsurer will pay the claims to policyholder. On the back end, insurer will transfer the premium and claims between the insurer and the reinsurer. Three main structures that is relevant in the asset-intensive reinsurance world. First one, straight co-insurance. Second, co-insurance with funds withheld. And third one is ModCo. I do have 3 separate pages to talk about the details and mechanics under each one, but this one has the summary of what it means for each one. They all satisfy risk transfer, meaning the reinsurer will take certain portion of the risk off the balance sheet of the insurer. The difference is under co-insurance, all of the assets and liabilities will transfer directly to the reinsurance balance sheet. Under co-funds withheld, only the reserves will transfer, but assets physically sit on cedent's balance sheet with the economic benefit still passing along to reinsurer. And for ModCo, both the assets and liabilities will sit on the cedent's balance sheet, but economic benefits and liabilities belong to the reinsurer. I'll double click on what we mean by cedent. Cedent in this case meaning the direct insurance company who is offloading their liabilities to the reinsurer. In addition to all of these, in order to provide protection to the cedent, typically reinsurer will provide comfort trust and over collateral to provide additional protection. I will just illustrate one of this structure to make sure that we get a hang of what it means by a certain structure. And I know that everybody has this deck, so you can take a look at the appendix, the last 3 pages on what each structure means. So for example, if there's a transaction that is going on for under a ModCo structure, this means that no physical assets or liabilities is changing hands at time 0, but they're changing hands over time between cedents and the reinsurer. There is a agreement between cedent and reinsurer on who is managing the assets. And under asset intensive reinsurance, typically the reinsurer will ask for the management of the assets because that's how they add value and can pay a healthy ceding commission to the cedent. And as you can see on this page, cedent will set up a model account under their balance sheet. So both assets and liabilities are still sitting on their balance sheet while the reserves are transferring over time. And what I meant by over collateral from the previous page is shown under this collateral account here, which typically in the industry is between 2 to 3% of the stat reserves in the current market space, just to add the additional safety for the structure. I'll pause here to go back to what we mean. Now we talk about structure. Next one, we'll talk about what is a flow reinsurance versus a block reinsurance. So typically there are 2 types of reinsurance in place in the market. The first one is called flow. The second one is called block. The difference between flow and block is flow is for a ongoing transfer of new business. So when an insurance company writes some new business of $100, they can transfer, say, 20% of that or $20 to a reinsurer to help out on capital requirement or to enhance the profitability of their product by receiving a ceding commission, or just to help out on the competitiveness of the product by receiving the ceding commission, then put it back on the product to enhance the credit rate, for example. For block transaction, comparing to flow, it is a one-time transfer of an in-force liabilities, meaning the policies are already written, is already sitting on the cedent's balance sheet. And there are multiple reasons for doing that. First of all, still for capital relief. Second is certain policies are no longer core to the cedent, and they'd like to offload that. The third one is, again, risk transfer. They might not be comfortable of holding certain type of liabilities, and somebody will pay them more for what they think is worth on their own balance sheet. So that's another way of doing, another reason to do block. In terms of size, both can be small or big. In terms of block, it's typically bigger because you need tractions from the market. By traction, meaning the interest from the reinsurer. And typically, if it's a bigger size, you have a better interest from the reinsurers to do this. And for flow, because it's an ongoing premium and depending on the frequency that the cedents is setting up their price, the price for the flow will change over time as well. So for example, if your cedent is changing their product credit rate weekly, then likely your reinsurance is going to change the rates weekly as well. So you're going to price for the smaller tranche each week. So for example, 10 million per week, then that's like a 40 something million per month. That's like a 500 million per year. So you still have $500 million changing hands from the cedents to the reinsurer, but the pricing will likely be different week by week. And you're going to talk between reinsurer and the cedent a lot more because of this ongoing collaboration. And because of this nature, because the reinsurer and cedents are talking all the time under the flow reinsurer, it is more a longer term partnership than a one-time transactional type of event for flow reinsurance to work. And to do that, cedent and reinsurer have to know each other really well. And there's some trust placed upon between the two as well. And why companies use reinsurer from the cedent's perspective. As I said, is lower capital requirement for ceded business, because when you cede $20 out of 100 off your balance sheet, you will pay only the capital for the $80, not 100. Then when you receive a ceding commission from a reinsurer, you can convert that into a fee income and then enhance your profitability from a cedent's perspective. Or the third one is you can also use that to enhance your product. You used to credit a 4% credit rate for MIGA. Then with 50 bips of ceding commission, you likely will credit 4.5. Then that will help you sell more of the business and be more competitive in the market space. What are other considerations that cedents are thinking through when they pick reinsurers under the asset-intensive flow side? Because it's a longer-term partnership, they care about how trustworthy the reinsurance is, if they can provide the comprehensive reporting and support to the cedent, then how comfortable are they to execute it within the timeline the cedent wants? For example, some cedents say, hey, I have to do this by year end 2026. Then likely they'll put a lot of effort on the experience of the team from the reinsurance companies and make sure that they have the execution certainty and speed and the bandwidth to get it done. And because there are a lot of requirement from NAIC for the reinsurer to provide to the cedent, cedent also care about the reporting capabilities from the reinsurer. What can they provide on the assets and the liability side? And what is the frequency of providing that? And obviously, because of the competitiveness that the cedent requires from the reinsurer, they have to testify of how consistently competitive that the reinsurance can be to support the cedents being competitive in the market. And there are basically three main jurisdictions when the reinsurers are doing the asset intensive flow, going to US, going to Bermuda, or going to Cayman. There are a lot of articles under each one of these. There's no one-way-fits-all type of event. It's more a case by case, depending on what the cedents feel comfortable. A lot of cedents will feel most comfortable if the reinsurance goes to US jurisdiction because that is the most familiar jurisdiction to a lot of the US cedents, and it follows the NAIC regulations and RBC. So we do see a lot of US cedents prefer facing a US entity. The second big one that's gaining a lot of traction is Bermuda. We do see lots of people pick Bermuda because, first of all, price could be slightly better than the US side. Second is for some of the Asia cedents, they are mostly familiar with a Solvency II type of framework, and that is a market value-based framework versus a book value-based framework. So we do see a lot of cedents will pick Bermuda out of the three jurisdictions I'm listing here for anything Asia particular transactions. The third one is Cayman. It's also getting more popularity at the moment, especially after SEMA announced, SEMA is their regulator. After SEMA announced that they will apply for reciprocal jurisdiction from the NAIC by end of this month. The regime here can be a book value or market value, so case by case, treaty by treaty type of considerations. A lot of people prefer that for flexibility reasons and pricing competitive reasons. Again, no right or wrong for picking one versus other. Typically, it is the cedents who is driving the conversation, and the reinsurers will typically provide pricing under each one of it. And then a lot of discussion will be going on before picking a jurisdiction. We'll talk about on the high level why company would like to do a reinsurance transaction. So this page laid out the main benefits for cedents to do this, mainly three things. The first one is the investment asset capabilities. A lot of the asset intensive reinsurance involve a lot of the assets to be invested. And so obviously the higher you can invest in your investment yield, the better or the more competitive you can be in the marketplace. So that is likely the number one driver that the reinsurer can add to the cedent's benefits. The second one is capital optimization. So Bermuda and Cayman likely is under economic framework. So at times the reserving is lower than the stat reserve if there's redundancy. And with that said, there's a lot of optimization going on the capital and reserving side, where the reinsurance can add value and pass along the benefit to the cedant. And the third driver is tax efficiency. So for reinsurance transactions, there's optimized tax structuring, whether you're paying the tax upfront or you're paying the tax over time. So if PV basis the tax is lower than a typical 21% tax efficiency under US, the reinsurer can pass along that benefit to the cedant as well. So all three levers added together is what you will see for the pickup from the cedant side on pre-reinsurance return versus post-reinsurance return. And because the asset side is the main driver, I do want to spend the last page talking more about what it means by adding value on the asset side and how do asset intensive reinsurers typically think about the portfolio construction. So again, everything begins with a illustration or negotiation on investment guideline before anything is done. So typically the cedants and the reinsurer will get together and see what would be allowed if reinsurer is going to take care of the investment on behalf of the cedant. So what would be allowed to invest in, what wouldn't? And for what is allowed to be invested in, what would be the limit for each asset class and each single issue limit. Give you an example. For example, it could be a 20% limit on CLO, 10% limit on ABS. So all of those is going to be determined upfront. Then the reinsurers will take all of these inputs plus the liability profile on how the cash flow works, how the key rate duration works, then come up with a bespoke portfolio for the cedant to match the liabilities from the asset strategies that the asset intensive reinsurance has. Then we'll do iterations for each of the set of investment guideline and then provide a ceding commission to the cedants. There are gonna be likely tweaks from the beginning to the end on trading off between investment guideline conservativeness versus a competitiveness on the quotes. Then the reinsurance will show, hey, this is our model portfolio, our strategic asset allocation. Are you feeling comfortable with it? Because it's gonna be a collaboration across different teams in the cedant side as well that spans between investment team, capital team, product development team, pricing team, and risk team. So when they all get comfortable, you'll move to the next stage of now we have the portfolio, we have the pricing. It's time to talk about treaties. Well, how do we paper this? What is included? What are the guidelines? Can we recapture this under certain event? So that's where the cedant and reinsurance will spend lots of time on the legal front. And then obviously the jurisdiction is part of the conversation as well, the accounting, who is reporting for what, the frequency of the reporting, the structure of the reporting. And after all of those are negotiated and settled, the treaty will go live on the flow side. Again, reinsurer typically will just match the frequency of the cedant. If they do rate setting monthly, then reinsurer likely will do rate setting monthly to provide a different quote to them each month. If the cedant is doing rate setting bi-weekly, then the reinsurers will just match weekly. Oh, the thing that matters the most would be the transparency and client engagement. ongoing transparency and ongoing communication is the number one key for a successful flow partnership to work between the two. And with all of this said, this wraps up the intro to asset-intensive flow reinsurance. I will stop sharing my screen and read some questions from the Q&A. So the first question I got is, what is the benefit of the modco for the cedant?
I think, Bingjie, before you answer, maybe you can expand the question a little bit. I know you talked about three structures, and maybe you can give our audience a little idea about how do people usually choose between the three structures, and what are the consideration behind that for cedant and reinsure, like between co-insurance, co-funds with health, and Monaco.
Yep, that's a good question. Let me share back my screen. So depending on the cedant, co-insurance, to begin with, you transfer all of the assets and all of the liabilities to your reinsurer. Cleanest, because you don't have to take care of your assets on your balance sheet anymore. Because some of the assets that reinsurers are investing are structured, bespoke, private type of assets. And some cedants do not have the capabilities to do that kind of accounting and reporting. So they much prefer for these kind of assets to sit on the balance sheet of reinsurer. Not all of the reinsurance can do co-insurance because some reinsurance are not reciprocal in the US, so you do not get the full credit if you do reinsurance. So in that case, they'll do co-funds held and ModCo to make sure that the cedant get the full reserve credit in this case. In addition to all of those, some cedant pick co-funds held and ModCo because rating agencies sometimes prefer to see a larger balance sheet when they review the companies. So as a result, some cedant will prefer the assets to be sitting on their balance sheet if they have the capability of doing the reporting. That's another driver why people pick co-funds held ModCo versus a co-insurance. And then the difference between ModCo versus co-fund held, going back to the question number one, is there are some tax implications if you are doing certain type of blocks on tax reserves, because there's a difference between tax reserve and stat reserve, and that will create tax liabilities or benefits if you do a reinsurance transaction. So that could be one of the biggest driver on people picking one versus the other. Also, from the reinsurance perspective, if you're going to a Bermuda entity that do not pay US taxes, but pay a federal X tax, meaning you're paying 1% of the premium upfront versus a ongoing premium, there's some implications on doing ModCo versus doing co-funds held as well. Pause here, seeing if, Linda, you have anything to add from your perspective, just given you're in the industry and have done a lot of reinsurance deals as well.
I think you summarized it well. Yeah, definitely. I think between Monaco and co-funds is how I can see tax could be a bigger consideration for sure. Um,
Great. I think we answered the first question. The second is, given the increase in exotic supporting assets involved in reinsurance of MYGAs and FIAs, our counterparties were regulators questioning whether the 102% comfort margin really is strong enough to cover the risk of such assets. Even if regulations might permit using only 102%, our practitioners using more to be safe. Again, this going back to the negotiation between cedent and reinsurer and how you pick the reinsurer. Typically, cedent will require highly rated reinsurer and has done a ton of deals in the past to see if they're reputable, if they're trustworthy. And the comfort trust level, it is a commercial item between the reinsurers and the cedent. Obviously, the higher you put up, the lower pricing reinsurers will be able to support on the product side. So I've been seeing a wide range. Historically, 2 to 3% is where I'm seeing the market is at right now for the MIGA FIA type of liabilities. If it's more, call it exotic, I wouldn't say exotic, but more complex than that, say USG, I've seen the market trading at a 5% over collateral level as well. But again, goes back to this bilateral conversation between reinsurer and cedent and what the cedent and reinsurance both feel comfortable with.
Yes, I can add a little bit is like for the comfort trust, everything sit in the comfort trust has to follow the investment guideline as well, and the investment guideline will be reviewed by the cedent. So definitely, it will be a investment guideline that cedent feels comfortable with. Um, it doesn't mean that the reinsurer can do anything or in the trust without any limitation. And if you have more questions, please use the Q&A to submit your questions. We did leave extra time for questions, um, and I know we're now very ahead of time.
Great. Not seeing anything popping up. Happy to answer any. Well, do you see the third one is do you see flow reinsurance being used outside of life and annuity space? So I covered the life and annuity space. I'm not sure about outside life annuity, but my suspicion is it's still mostly used in the life annuity space as of now. PNC side is picking up on doing reinsurance and setting up sidecars, but seems like certain type of flow is better suited on life annuity versus PNC at the moment.
Yeah, I know Bingjie talked about FIA and MIGA, but I know for UL type of product, you can also see flow reinsurance. But again, the pricing could be a little more complex. It's just because for life policies, it's you have more customized risk, right? Because it's your individual mortality risk versus FIA and MIGA, they are more accumulation products. Uh, Mortality risk is not a major risk, so there is less underwriting with regards to that, and we definitely also see a flow transaction on SPIA blocks, and for those, definitely the pricing would be a little more complex. You would have multiple like cells to capture different policyholder ages or gender or other characteristics.
Next question we see is any more comments on how Cayman/SEMA regulation might tighten or change if they are recognized by US? So we do see that Cayman is gaining more tractions and they have developed certain regulations to support growing their reinsurance business. Their premier is very public on getting recognition by NAIC. So there's work streams under CIMA to do that. What the industry is advertising at the moment is more education on the jurisdiction, because people are very familiar with the US RBC framework. More and more people are more familiar with the Bermuda framework, but not a lot of the people at the moment is familiar with the CIMA framework. So believe the regulators at Cayman recognize that, and is working on educating the market over time.
What is going to be the proposed framework for Cayman? Is that more market value basis or book value basis?
I think you can still do both.
Oh, okay.
And I've seen practitioners doing both, to my knowledge. Is probably just you do not have to disclose as publicly at the moment. As in the US/Bermuda, that causes certain confusions in the market. So we'll see if that is to change or not.
You have another question. Is reinsurance market consolidating?
It is a good question. I get that a lot. I would say that overall insurance market is still booming. Retirees are getting to retirement age, so they need safety for retirement product. So overall market is exploding. Then with that said, you do have a lot of the insurance companies selling very similar product at the moment. In order to be competitive, asset intensive reinsurance is definitely a lever to do that. So that's why a lot of reinsurers are entering the market or have recently entered the market to capture that market share. To the latest of my knowledge, there are 20 plus reinsurers at the moment who are doing asset intensive reinsurance at the moment. So to the question owner's credit, there is a lot of competitions going on what you can do as a reinsurer in the current environment. I do see the potential for consolidating, just given the overly competitiveness of the reinsurance market. But I don't see anything in the very short term because people are still trying their best to get their cedent to make sure that they have supported their cedent. So I'm personally in the wait and see mode. But again, that tells you that it's very important for the cedent to be doing due diligence on your reinsurer because not everyone can support you longer term, and not everyone can be existing as long as you hope them to be.
So here's another question. Are there any other jurisdictions that are on the horizon for where reinsurance can be done? I know Bermuda, US, Cayman, but are there any others on horizon?
Yeah, there are certain players using Barbados. There are a lot of players using Ireland. There are some players are in Puerto Rico as well. I think ENY issued certain white paper on reinsurance jurisdictions a couple of months ago. So that is a pretty good primer to look at what else is there. But the main things, as the person pointed out, rightly to be, the most popular ones are Cayman and US and Bermuda.
So just an additional comment. So for Barbados, uh, I rarely see cedant would want to face Barbados directly, so Barbados is probably more to use as a internal retrocession of the reinsurer, correct? Like,
Yeah, that's my observation as well, Linda.
okay, yeah, just like to additional notes. Yeah, the paper by ENY is a SOA research paper. Basically described the uh a handful of international jurisdiction for reinsurance consideration. And we are also going to have a session on Friday, having people from EY talk about two of the jurisdiction on Friday as well. So, and the next question is, do you have any observation or comments to share on how cedant and offshore reinsurer handle the first year of complying with the AG 55?
Yeah. I would say that getting a lot of attention, getting some requests from the cedants from the reinsurance perspective to provide reporting, settlement, but a lot of these were already done in the typical settlement reporting and the support that we at Aspida and Ares are already providing. So not a lot of change from our side on complying with AG 55 and feels like the guidance as of now is more qualitative than quantitative. So as a reinsurers, we support everything that our cedant is asking for. So feedback is still TBD at the moment from what our cedant receives from their regulator at the moment. But so far, we as an industry seem to be complying with AG 55 and is supporting the cedant in that way.
Okay, I think we still have some time. Feel free to submit your question. I'm going to ask my question just to would like to hear your insight. Because I think 2 weeks ago, Iowa announced that they rewrite their captive law to welcome more reinsurance to be back on shore, and they also seems to providing good tax um discount as well. And like now it's there are a couple states that start to provide permitted practice like through the captive solution for reinsurance. What is your um kind of insight about that? What's your view on that? Is that going to be a trend or
Yeah, good question. I do see a pickup from the certain states of issuing regulations to be more friendly to set up captives within the US. Um, and Iowa is one that you mentioned. Prior to that, it's very public, was Michigan that had one, and then Ohio as well. So from the industry's perspective, we do see pickup on that. At the end of the day, again, it is the flexibility from the jurisdictions that will determine where the liabilities go, whether that's U.S., their domicile state, or if it's Bermuda, or if it's Cayman. So a lot of the life insurance companies I'm speaking with do not have a strong preference or opinion going one way or the other. But honestly, if the NIC is able to offer very similar treatment between home state versus Bermuda, for example, you probably will see captive in US picking up as a trend, which I am seeing these days.
thank you.
Cool. Looks like we answered all the questions we have in the dialogue.
And we have some comments like to see if we can go over the appendix slides a little bit.
Oh, sure. Back my screen. Sorry, by appendix, do we mean the structure slides or do we mean the asset slides? So basically, I had three different slides on co-insurance. What is that? Modco, what is that? Then co-functional, what is that, right? Planning to post this after the meeting, so people can read more about it, and then how the flow chart works in terms of gain, losses, claims, premiums, and reserve transfers. As we hit before, this 2 to 3% really depends on the market and the negotiation between the cedant and the reinsurer. And I know that in the actual presentation, I walked through Modco. So this one is the co-funds withheld. The difference between these two is for funds withheld, the reserve actually transfer, but assets stay behind on the cedant balance sheet. And a lot of the cedants will determine they want to make the trade-off on if assets show on their balance sheet. So that's a good thing in terms of your total balance sheet size if people look at you as a total company basis. On the flip side, certain asset classes, the accounting team might need additional support to report that on a timely basis. So that is some of the struggle that we've been hearing from the cedant side on if the assets is too private or bespoke, they don't want to put that under their balance sheet. And I see another question just popping in. Does the cedant or the reinsurer typically handle the hedging for FIAs? I see a healthy blend of both, actually. Some cedants said they're very efficient of hedging. They've been hedging it for the last 20 years, so they want to keep doing it and charging a slight fee for the reinsurer. In that case, cedant will maintain the responsibility for hedging for the entire book of 100%. Sometimes cedants are relatively new to the space, and reinsurance have done a lot in the space on the hedging. So it's the other way around. Reinsurer will take care of the entire hedging. Sometimes I also see that say, hey, reinsurance takes 50% of quota share, cedant takes 50% of quota share. They don't want to intertwine each other with the hedging strategy, so each one will take 50% of the entire book. So again, it's like flow reinsurance is a very partnership-like type of reinsurer. Everything is through discussion, negotiation. So you will see a lot of flexibility in this point as well.
Hey, Bingjie, did you answer the last second question? So that your second to last point on the co-funds with our reference model, how would you change this for co-funds with how? Wasn't
Oh, yeah, I think might be a typo, huh? Yeah. Anyone just didn't. Oh, so I think the person is referencing. I still reference the Mako. I'm sorry about that. I'll change that to co-funds for help or this page. The next question we have is a case where reinsurance took a block from break even to profitability, or where the reinsurance helped the company. Yeah, sure. I'll give an example. So the question is basically a case where reinsurance can help out from break even to profitability, or the reinsurance help the company correct errors in pricing. So one example that happened recently is Aspida helped a new entrance to the annuity space as the reinsurer for their MYGA product. they have been selling life product for a long time, but annuity is relatively new to them. So we helped out on opining on the designing of the product, on how the lapse would work, how the partial withdrawal would work. Then we also helped opine on expense allowances, meaning the commission to the agent, the expense, the overhead, and the acquisition cost and maintenance cost. Throughout the pricing, throughout receiving the data from the cedent, we did our own version of the access modeling where we just couldn't match certain portion of the projection from the cedent. And after going back and forth, we realized that there are certain cells from the company. In this case, is the 65 to 70-year-old age band that the cedent have a error on coding from their side. So it just couldn't match from the validation point of view. So in that regard, we helped the company correct that in their system. So that was very well received by the cedent. So that's another added benefit of doing reinsurance with a trusted partner, because it's another way of validating your own work through somebody independent and third party. Hopefully that answers your question. And then should we wrap it up? And
Yeah.
for more questions, feel free to add me on LinkedIn or send me an email, bli@aresmgmt.com. I'm happy to get together on informal calls or meetups if you have interest to learning more about reinsurance or asset-intensive reinsurance.
Thank you, Bingjie, for your presentation. And thank you, Linda, with your help with the Q&A.
Yeah, thank you everyone like submit the question. I think this is actually a pretty active discussion.
It was very interactive. I see
I see one people
hands.
raising the hand. Would you be able to do that through the Q&A or?
Yes, Mark, can you put your question into Q&A? If you don't see the button at the bottom of your screen, you can choose more with 3 dots and it should be under there. We still have time. We can wait for a minute or two if it's okay with you, Bingjie.
Yeah, of course.
Okay. Mark Cummings. Okay, while we wait for the question, just letting everyone know that the second session will start exactly at noon Central. Okay, let's give another minute. And like Bingjie said, we can put your slides up to our website once the webinar is over. And we can add your contact information there so they can add you in LinkedIn, your name, your company. And I don't see any new questions. So I guess thank you again, Bingjie.
Thank you,
Let's
guys.
finish our first session here. We are going to take a 5-minute break, but the sessions will still be live. So please come back exactly around noon for our second session. Thank you so much.
Bye.